Okay, so capital adequacy management. The capital adequacy management to do what? To do first, prevents bank failure. So prevents bank failure. It is also important for the equity holders, for the capital that affects the return for the owners of the bank. So the second one might be the amount of capital affects what? Something that for the equity holders are important, the return. For the owners of the bank. And also is important for what? For a minimum amount of bank capital, the bank capital requirement, okay, that is required by the regulatory authorities. So a minimum amount of bank capital. Okay, we call the capital requirement. Okay. So the capital adequacy management is important. Let's consider two banks, the bank 1 and bank 2. So let's consider these two banks with similar balance sheets. So we have the asset side here, the liability side here. For the second bank, let's say we have the similar situation, so the asset side here and the liability side here. Except the first bank has a ratio of capital to assets of 10%. So the ratio of capital to assets for the bank 1, let's say 10%, and for bank 2, the ratio of capital to asset, let's say, is 4%. Okay, so on the asset side of the bank 1, what we have is the reserves. Okay, let's say 10 million of the currency unit. We can have also loans that we can consider here. In our example, it is 90 million. And then on liability side, we have what? We have the deposits. 90 million of the currency unit. And we can have the bank capital on the liability side. So the bank capital, that is 10 million, okay? So for bank 2, we can say that this is balance. For bank 2, we can consider the same items, the reserves that appear on the asset side with the 10 million. The loans, as we said, the balance sheets are similar, 90 million. Okay, so the deposits. Okay, let's say for this bank, 96 millions, and the bank capital $4 million. Okay. So what will happen if they experience 5 million of their loans, okay, from this amount become worthless, and these bad loans, okay, they will do what they are written off, right? So we will experience 5 million of the loans that they will be the written off. So on the asset and liability side, what we might have for asset side and liability side. So here the reserves, we have the 10 million of reserves. For the loans, as 5 million of the loans became worthless, so we have 85 million here. And for deposits, we have the similar deposits, so 90 million as we had before. And for bank capital, we will have what? 5 million. Okay. So for bank 2, on the asset side and on liability side, for the reserve, similar to what had for the first bank, it is still 10 million. For the loans, change is 85 million. For the deposits, change 96 million. And for the bank capital, it will be what? We had 4. We experienced 5 million of the loans that it became worthless. So it will be minus 1 million here, the 4 that we have here. Okay, so right. So because of what is happening here, the second bank is in big trouble, right? The value of its assets has fallen below its liabilities, and its net worth is now what? The bank has a negative net worth, okay? Here we have the negative 1 million. So it is insolvent. And it means that it does not have sufficient assets. So the bank too the net worth is equal to 1 million. So it is insolvent. And it means that it does not have sufficient assets to pay off all holders of its liabilities the creditors, right? So government regulators will close the bank and its assets are sold off and its managers will be fired. So that's a very big problem for the bank. And to measure this kind of things and to have an idea that what might happen in the future for the bank, we might look at the amount of the bank capital and returns on equity. So the amount of bank capital is important to be monitored, right? So how we can monitor this amount of bank capital and returns to equity, for example, for the holders, we can use the measures like ROA. That is what? That is the net profit, of course, after taxes. Over the total amounts of the assets that we have in our balance sheet. And also something else that is important is this ROE, the return to equity that we said. So it is equal to what? It is more important for the holders of the bank, for the owners of the bank, because it really shows that from the capital, what is the net profit that the bank is making. So the net profit, again, similar to ROA after taxes, but this time over what? Over equity capital. Okay. So the net profit after taxes over the equity capital could be written also equal to what? To the net profit after taxes. The net profit after taxes, okay, over the assets. It means that this ROA that we have here times assets over what? The equity capital that we have here. So we call this part EM. So we can say that ROE is actually equal to ROA times EM. And the ROA, as we discussed also in our classes, is representing also kind of good management of the bank, and the EM a little bit related to the risk management and how much the risk is managed well in this bank. Okay, so these are the measures that we can monitor. The capital adequacy management are important for all these reasons that we discussed here. And we have different measures that we can look at them to know about what really is happening. So we can say that the ROE is something that is important for the holders of the bank, to tell us what happens to the return on equity when a bank holds a smaller amount of capital or equity for a given amount of assets, right? So we have this equation. And in our example, that the first bank, for the first bank, okay, initially has what? 100 millions of currency units of assets. So the amount of assets, and also 10 million of equity. So 10 million of the currency unit as the equity, which gives it an equity multiplier of what? The equity multiplier would be 100 million over 10 million means 10. Okay. So for the second bank, we had 4 million of equity. So its equity multiplier is higher. Equity multiplier would be what? Would be 100 million over 4 million, 25. Okay. So suppose that these banks have been equally well run, so that they both have the same return on assets. So the return on assets, let's say 1%. And is equal for the bank 1 and bank 2. So the return on equity for the high capital bank equals to what? To 1%. Times 10 for the first bank. While the return equity for the second one, okay, would be what? 1% times 25 for bank 2. So the return on equity for the first bank is 10%, for the second bank 25%. So the equity holders in the first bank are clearly a lot happier than the second bank, right? As the return on equity is much higher than the first bank. So why may not owners of a bank like to hold too much capital? So, because given the return on assets, similar to our example, that is equal, the lower the bank capital, the higher the return. For whom? For the owners of the bank. Okay. So what we can say is that the net income over the equity, okay, the ROE is related to the return on assets, the net income over total assets, and also kind of leverage, the EM, that is the total assets over equity. So we can imagine a financial report of a bank. Let's say the income statement. And also the balance sheet. That they can give us enough information to measure whatever is necessary for the asset and liability management, or for considering the performance of the bank and monitoring the performance of the bank. So for the income statement, we have several items. But finally, what really is important for us is the net income, right? So we have the operating income here, the operating incomes. Clear what? First, the interest income. The interest income, like the interest on loans, interest on securities, and other interests that they are possible. We have also the non-interest income, all income that they might happen because of the services, because of the fees and service charges on deposit accounts and other non-interest incomes. And we have some expenses, right? So we have the operating expenses. We have also the interest expenses, that are the interest on deposits, the interest on whatever we receive from the other banks or from the central bank. And we have the non-interest expenses, also the salaries and employees benefit, premises and the equipment, whatever we need to run the bank, for the human resource or for paying our bills, and all expenses that it might happen. And we have some provisions that we have to consider. So we have the provisions. Mostly it is for loan losses, okay? And we can have the total operating expenses from all these expenses that we have here. We can have total income that the bank can achieve. And then what we can calculate is the total income without considering the taxes that they might be also considered to have the net income, okay? So if we have the taxes here also, then we can have the net income as a result. So from the income statement, we can have this information, also the capital and the assets that we have could be achieved from the balance sheet. So the ROA is a useful measure, okay, as we said, as a measure that we can consider to how well a bank manager is doing on the job. And it indicates how well a bank assets are being used to generate the profit, right? So it is not what the bank's owners, the equity holders, care about most of the bank operations. They like to know about not only the ROA, they like to know also about the ROE, right? So ROE for them is much more important. So we discussed how to measure a bank's performance in our classes and also here by the balance sheet and income statement measures and indicators, but only a simple example to cover the shortcomings of net income, which does not consider the bank's size. Considering the ROA as a measure is working better. It's like checking if chef makes the most of the kitchen to cook delicious dishes, okay? Similar to the managers of the banks, that they like to have the highest return from whatever they put in the bank or the action that the bank is doing and providing the services and all the facilities for the financial system. And in a sense, it shows us how well a bank uses what? The assets to make what? The profits. Okay. So ROA is our go-to metric to assess a bank manager's effectiveness. So it's about more effectiveness, and it's about efficiency just like what? Just like our chef making the most of their ingredients and make or cook a delicious dish, okay? So the ROA, as we said, is what? The net income over the assets, and the ROE, the net income over the capital. We can say also equal to net profit margin times ROA times financial leverage, AEM. It is what? The net profit over the sales the ROA, we can say sales, whatever is coming from the income statement, over the total assets that we put there, and the financial leverage, we can say is the assets over the equity. Okay. So another measure that we might consider might be a difference between what? not the assets and liquidity, from the interest. So we had also the interest expenses here. We had also the interest income here. So the interest received minus the interest paid. Okay, so whatever we might receive from the currency unit to whatever we pay as the interest for the people that they save money in our bank. So this difference between these two can be also interesting. So it will give us a kind of margin for what? For the interest, right? So if we know the invested assets and the amount of the invested assets, and we consider or compare the income that we might have from the interest or even the loss, and compare these two to each other as the average invested assets can be here. Okay. It can give us a good measure that we call it the NIM, or the net interest margin. Okay. As the difference between the interest received and interest paid over the average invested assets. Okay, so it is another commonly watched measure of bank performance, and you can see in the reports. Usually we have a table. Okay, so you can see that we have the year here. Okay, let's say from 2010, okay, 11, for different years. We can report what? First, the ROA, the return on assets. So the different measures for the return on assets, the ROA. So here we have the ROA. We can have the return on equity. The ROE for different years. And we can have this net interest margin. Okay. So this table will be very useful to monitor the performance of the bank, and if a bank manager is skilled at handling the bank's assets and liabilities, making sure the bank earns a lot from its assets while keeping costs low. So patterns of assets. keeping costs low on the liability side, right? It means what? It means the bank will be more profitable, right? So the way a bank manages its assets and liabilities depends on what? Depends on the difference between the interest earned on the bank's assets, okay, and the interest cost on liabilities. So we call this difference the NIM, or the net interest margin, and it shows the bank effectiveness in managing in financial resources. So this NIM, the NIM, can be considered as a key gauge of banks' effectiveness in managing its financial resources.